Welcome back to the Daily Crypto Roundup, the podcast where we don't just read you the charts, we tell you the stories that are shaping the entire digital asset market. And what a week it's been. We've seen one of the most important announcements in stablecoin history with Tether unveiling its brand new regulated US coin. We've witnessed Gemini, the exchange run by the Winklevoss twins, pull off one of the hottest IPOs on Wall Street this year. ETFs are back in the headlines, pulling in over $1 billion of institutional inflows. And to top it all off, XRP is gearing up for a potentially game-changing October, when the SEC is due to rule on ETF applications. In this episode, we'll break down what happened over the past week, what it means for your portfolio, and what to watch for in the days ahead. From Tether's attempt to finally silence the critics, to Gemini showing that Wall Street still craves regulated crypto exposure, to ETFs proving that institutions are not just flirting with digital assets, but fully allocating, there's no shortage of action. But before we dig in, let's check the prices and set the stage. Bitcoin, $114,600. Ethereum, $4,470. Sol, $239. XRP, $3.05. Avax, $51.90. Doge, 25 cents. LTC, $91.20. The total crypto market cap is holding just above $4.1 trillion, a number that seemed like fantasy only a few years ago, but today feels like a solid floor. Now, let's dive into our first big story of the week, and it's a huge one. Tether, the company behind the world's largest stablecoin, is launching a fully regulated US-based token called USAT. To understand why this matters, you have to rewind a bit. Tether's USDT has been both the engine of the crypto market and one of its greatest liabilities. On one hand, it powers the majority of global trading. Every day, billions of dollars in Bitcoin, ETH, Sol, and countless altcoins are bought and sold using USDT as the base pair. On many exchanges, especially offshore platforms, USDT is the actual dollar of crypto. But for years, critics have asked the same question. What really backs it? Tether has repeatedly promised transparency, but has often failed to satisfy regulators or journalists. The New York Attorney General forced a settlement in 2021 after finding that Tether at times didn't have full reserves. On several occasions, USDT has briefly slipped from its peg, sparking fears of collapse. Despite all that, Tether survived. More than that, it thrived. Today, Tether controls over $110 billion in circulating supply. Compare that to Circle's USDC, which sits closer to $30 billion, and you see just how dominant Tether is. For many in the industry, USTD is the unspoken kingmaker. If Tether fails, markets crash. If Tether holds, the bull market can run. That's why the announcement of USAT is so fascinating. Instead of continuing to operate at arm's length from US regulators, Tether is now saying, fine, we'll meet you where you are. USAT will be issued directly through Anchorage Digital Bank, one of the few federally chartered crypto banks in the US. Its reserves will be managed by Cantor Fitzgerald, a firm with deep ties to Wall Street and decades of experience in securities. And unlike USTD, USAT will commit to full audits and transparency from day one. This isn't just another product, it's Tether trying to reinvent itself. They've even brought in political muscle. Bo Hines, a former Trump Advisory Council member, has been tapped to lead the effort. That's not a coincidence. Tether knows that stablecoins are about to become a political football in Washington, and they want allies. By putting a politically connected figure at the top of the US branch, they're signaling that USAT is designed to play nice with regulators. Analysts are already reacting. Mark Palmer, managing director at BTIG, who has covered both Circle and Tether for years, said in a Reuters interview, "If Tether can actually deliver on its promise of transparency with USAT, it could completely shift the perception of the company." The irony here is that the most opaque issuer in history might end up running the most transparent stablecoin in the US. That's a powerful statement. But what does this mean in practice? First, it brings direct competition to USDC. Circle has spent years cultivating an image as the regulator's favorite. Its CEO, Jeremy Allaire, has met with Congress, testified in hearings, and pitched USDC as the compliant alternative to Tether. For a time, it looked like Circle had the inside track. But now, Tether is showing up to the same race with deeper liquidity, global dominance, and a shiny new regulated wrapper. If institutions begin to migrate toward USAT, Circle could lose its key advantage. And for Tether, it would mean not just surviving regulatory scrutiny, but turning it into a moat. Of course, skeptics remain. Critics point out that Tether's track record is full of broken promises and partial disclosures. They argue that slapping a new label on a stablecoin won't erase years of mistrust. Sheila Bair, former chair of the FDIC, speaking on Bloomberg TV, put it bluntly. Trust isn't something you announce. It's something you earn over years. Tether has a long way to go before regulators or large institutions fully embrace them. Still, the move changes the game. For the first time, Tether is going on the offensive in the US, not just defending itself. And the timing couldn't be better. The US Congress is actively debating stablecoin legislation. Draft bills are circulating that would require issuers to hold one-to-one reserves, submit to audits, and operate under bank-like supervision. Circle has already positioned itself to comply. Now, Tether is signaling that it too wants a seat at the table. Think about the stakes. Stablecoins are the glue of crypto. They connect the on-ramps and off-ramps, they underpin trading, and they're the first crypto asset many institutions experiment with. If Tether can run a compliant US stablecoin, it doesn't just protect its dominance, it extends it. There's also the macro picture. Central banks are dragging their feet on CBDCs, but the private market isn't waiting. If USAT launches smoothly, it could accelerate adoption of crypto dollars across fintech platforms, remittance providers, and even e-commerce. Imagine paying with a regulated Tether coin inside PayPal, Shopify, or Square. That's the kind of mainstream adoption Circle has always dreamed of. And now Tether wants it too. The next 6 months will be critical. If USAT gains traction, we might look back at this moment as the day Tether stopped being the industry's dirty secret and became its institutional backbone. Now let's move to our second story, Gemini's blockbuster IPO. Cameron and Tyler Winklevoss are names that have been tied to crypto since the very beginning. They were mocked as the Facebook twins who sued Mark Zuckerberg, but then laughed last when their early Bitcoin buys made them billionaires. And now, more than a decade into the crypto story, they've put their exchange, Gemini, onto the biggest stage of all, the public markets. Gemini priced its IPO at $28 a share, raising $425 million and giving the company a valuation of roughly $3.3 billion. That's already newsworthy. But here's the kicker. Demand was more than 20 times oversubscribed. That means Wall Street wanted far more Gemini stock than was available. Even NASDAQ itself invested $50 million alongside the IPO. This wasn't just another listing, it was a statement. To understand why this matters, you need to compare it to Coinbase's IPO in 2021. Coinbase was the first big crypto exchange to go public, and it did so at the height of the bull run. Shares debuted at almost $400, only to crash below $50 within 2 years as the market turned. For many institutional investors, Coinbase became a cautionary tale. Crypto exchanges were exciting, but too volatile, too unregulated, and too exposed to boom and bust cycles. Gemini flipped that script. Instead of chasing hypergrowth, Gemini focused on compliance and security. While Binance sprinted ahead with global volume and Coinbase expanded aggressively, Gemini moved more cautiously. Critics said they were too slow, too boring. But in the long game, that narrative shifted. Kathleen Smith of Renaissance Capital, one of the most respected IPO analysts in the US, put it like this. The Gemini IPO shows that investors don't want flash right now, they want trust. Coinbase burned people. Binance is a regulatory nightmare. Gemini positioned itself as the safe, compliant option, and Wall Street rewarded that. And it's true, Gemini's reputation is squeaky clean compared to its rivals. They never had the scandals of FTX, the SEC lawsuits of Binance, or the aggressive listing practices of some smaller exchanges. For institutions, that makes Gemini the obvious safe bet. What does this mean going forward? First, Gemini now has a war chest. With $425 million raised, they can expand their product lineup, push deeper into international markets, or even make acquisitions. Some analysts speculate that Gemini could target smaller exchanges in Asia or Europe to boost liquidity and trading volume. Others believe they'll double down on building out regulated custody services for institutions. But there's another angle. This IPO has reignited conversation about which exchange might be next. Kraken has long hinted at going public, and with Gemini's success, that pressure will only build. If we start to see a wave of compliant exchanges listing on US markets, it would mark a sharp break from the wild, unregulated history of crypto trading. The IPO also reopened the debate about valuations. At $3.3 billion, Gemini is far smaller than Coinbase's peak, but investors may actually prefer that. It feels more realistic, more sustainable. If Gemini stock holds its ground, or even climbs, it could restore institutional faith in the idea of public crypto exchanges. Ben Weiss, CEO of CoinFlip, told Barron's, "Gemini's IPO is less about today's valuation and more about proving that exchanges can exist in a regulated, transparent way. If Gemini performs, it helps the entire industry. And then there's the human element. For Cameron and Tyler Winklevoss, this IPO is redemption. They were dismissed as also-rans in Silicon Valley. They were told their slow approach to crypto would doom them. Today, they're running a publicly traded company that institutions are lining up to invest in. That's a narrative arc you couldn't script better if you tried. The next few quarters will be critical. Investors will want to see growth, yes, but more importantly, they'll want to see stability. If Gemini can avoid the pitfalls that drag down Coinbase, like over-reliance on retail trading fees, then it could become the model for what a compliant, institutional-friendly crypto exchange looks like in 2025 and beyond. Now let's shift to something that doesn't get the flashy headlines, but might be even more important: ETFs. Over the past week, Bitcoin and ETH ETFs have pulled in more than $1.1 billion in fresh inflows. Bitcoin led the way with $642 million, while ETH wasn't far behind at $406 million. These aren't just numbers. They're a signal that institutions are treating crypto not as a side bet, but as a structural part of their portfolios. Eric Balchunas, senior ETF analyst at Bloomberg, has been tracking this closely. He explained, "When you see consistent inflows at this scale, it means institutions aren't just dabbling. They're allocating. Bitcoin is being treated like digital gold. ETH is being treated like a digital bond, offering yield and utility. That's a massive shift in how these assets are perceived." Think about that framing. Bitcoin as digital gold, Ethereum as digital yield. That's not meme talk. That's Wall Street strategy. Pension funds and hedge funds are literally building crypto into their portfolio models. It's also telling that ETH inflows are keeping pace with Bitcoin. For years, institutions were skeptical about anything beyond BTC. It was the only coin they felt comfortable holding. But now, with ETH ETFs, they're clearly willing to spread capital across both. That diversification says a lot about how far ETH has come. From the world computer experiment to an institutional-grade asset. The mechanics matter here too. Retail traders buy and sell at whim, but institutional inflows through ETFs tend to be long-term. They're often part of retirement funds, endowments, or strategic allocations. That means the money coming in isn't leaving anytime soon. If we look at the bigger picture, total ETF inflows since approval have now crossed tens of billions. That's new demand that didn't exist in prior cycles. And it helps explain why Bitcoin is holding above $110,000, and why ETH is pushing back toward $4,500 despite market consolidation. Of course, not everyone is convinced this can last. Some analysts worry that ETFs might create a two-tiered market, one for institutions, one for retail. Others argue that ETF demand could dry up if macro conditions turn against risk assets. But so far, the trend is only pointing one way: up. Kathy Wood of ARK Invest, whose firm was one of the earliest to push for Bitcoin ETFs, commented this week, "These inflows are just the beginning. Institutions are notoriously slow to move, but once they start allocating, they keep going. We believe Bitcoin and ETH ETFs will become permanent fixtures in diversified portfolios. That's a bold claim, but it fits the evidence. Now here's the kicker. Some analysts expect ETF inflows to double in Q4 if the Fed follows through with expected rate cuts. Lower rates tend to push investors toward risk assets, and with ETFs now available, crypto is no longer off the table for conservative institutions. Imagine another $2 billion or $3 billion pouring into Bitcoin and ETH over the next few months. That's the kind of capital that can fuel the next leg up, not just for those two coins, but for the entire altcoin market that follows their lead. This also raises the question of what comes next. If ETFs for Bitcoin and ETH are thriving, how long until we see ETFs for SOL, XRP, or even baskets of altcoins? The demand is clearly there, and regulators are slowly softening. A year ago, the idea of multiple crypto ETFs would have sounded far-fetched. Today, it feels inevitable. For now, though, the story is simple. Institutions are here. They're not just testing the waters. They're writing big checks, and ETFs are the bridge making it happen. Quiet on the charts, loud in the community. That's XRP right now. At just over $3.05, it's holding steady. But beneath the surface, there's tension building. That's because mid-October is shaping up to be one of the most important moments in Ripple's history. The SEC is due to rule on multiple XRP ETF applications. Yes, XRP could be next in line for the kind of institutional inflows we've seen transform Bitcoin and ETH this year. If approved, it would mark a dramatic shift in how XRP is perceived. From a cross-border payments token to an institutional asset that sits on the same shelf as Bitcoin. John Todaro, senior analyst at Needham & Company, framed it like this. If the SEC approves the ETF, the re-rating will be instant. Institutions don't want to hold tokens in private wallets. They want regulated products. Approval would give them that, and it would create real inflows almost overnight. That's why October matters. On one path, approval sets off a wave of new money. On another path, rejection or delay leaves XRP stuck in limbo. Ripple has spent years building partnerships with banks like Santander, SBI Holdings, and even central banks in Asia. Those relationships give XRP real-world utility, but without institutional access, its price has lagged behind the bigger names. An ETF changes that dynamic completely. The XRP army knows it. They've been waiting years for this moment. On social platforms, optimism is boiling over. Memes about XRP to $10 or even higher are back in circulation. Some analysts say $5 is possible if ETFs are approved, while others warn against irrational exuberance. Linda Jones, a veteran market analyst covering fintech IPOs, offered a cautious view on CNBC. XRP has a strong community and Ripple has real partnerships, but ETF approval is far from guaranteed. The SEC could just as easily delay decisions into 2026. Investors should temper expectations. Still, even skeptics admit that October is a critical inflection point. If approval comes, XRP could quickly move from niche status to mainstream. If it doesn't, the community may need to prepare for more patience. Beyond the blue chips, the altcoin world is buzzing. One of the most talked about names is Remittix, or RTX. In just a few months, it has raised nearly $25 million in pre-sale funding, sold over 655 million tokens, and confirmed listings on Bitmart and LBank. Its pitch? Becoming a PayFi leader, enabling near-instant cross-border payments between fiat and crypto wallets. It's an ambitious vision. Think Ripple's cross-border utility, but targeted at retail and fintech apps. If they execute, RTX could carve out a niche. But let's be real, most pre-sales don't live up to the hype. The difference with Remittix is the scale of its fundraising. Analysts are watching closely, not because it's guaranteed success, but because it's one of the few pre-sales with enough traction to matter. Meanwhile, established altcoins are heating up. SOL continues to impress at $239, with trading volumes soaring, and futures open interest climbing. Developers are pumping out applications, and daily transaction counts are dwarfing those of Ethereum. Institutional chatter about a possible SOL ETF only adds fuel to the fire. Avax is steady at just under $52, but headlines around the Avalanche Foundation's $1 billion token accumulation program keep it in the conversation. Analysts are debating whether this strategy artificially props up price or genuinely drives long-term value. So what should we watch heading into the new week? First, stablecoin regulation. With Tether announcing USAT, all eyes will be on Congress. The Genius Act has already opened the door for compliant stablecoins. If lawmakers start signaling timelines for implementation, expect headlines to move both USDC and USAT. Second, Gemini's stock performance. After raising $425 million and pricing at $28, the big question is whether the stock can hold up in its first full week of trading. If Gemini performs well, it could spark renewed interest in other exchange IPOs like Kraken. If it stumbles, critics will say Coinbase wasn't an outlier, that the market simply doesn't trust exchanges. So what ties all of this together? It's clear that institutions are no longer dipping a toe into crypto, they're diving in. Tether is reinventing itself with a US-regulated stablecoin. Gemini has proven Wall Street still craves exposure to compliant exchanges. ETFs are sucking in billions, showing that Bitcoin and ETH aren't fringe bets anymore, they're portfolio staples. And XRP is on the verge of either its greatest catalyst ever or another long wait. Add in the energy of altcoins, Sol's developer boom, Doge's payments push, Remittix's ambitious presale, and you've got a market that feels alive in every corner. The narrative has shifted. Crypto isn't begging for adoption anymore. It's here. Institutions are allocating, retail is speculating, regulators are finally drawing lines. And through it all, one thing is clear. The next 6 weeks could define the rest of this bull cycle. As always, crypto family, protect what you hold. I use a Ledger wallet myself, and you can grab one through the link in the description to keep your assets safe before CBDCs arrive. That's it for this week's extended daily crypto roundup. Catch us here every day and on Spotify. Drop your thoughts in the comments, smash like, hit follow, and we will see you at the top.